Upadhyay, good morning. Thank you for joining us. Harsha, the watchword on the street is be cautious. And I think be cautious is going to be the sum and summary of today's interaction, right? Whatever I will say, you will say be cautious, right, Harsha?
Nikon, see, the market undertone has been quite bullish for last 2 months or so on the back of enhanced liquidity from foreign investors and also steady flows from domestic investors. We have seen markets reaching all-time highs. So to that extent, without earnings changing much, we have seen markets moving up by maybe about 10 to 12% in the last few weeks. So to that extent, yes, market has become a little more richly valued compared to where we were at the beginning of the year. And obviously there are big events such as election and also the earnings season, because a lot of focus would be there on earnings season, because consistently the market has been expecting higher earnings, and that trajectory has not been coming through. So to that extent, what would happen in financial year 2020 would also drive the markets. So given all these factors, I think some amount of volatility is expected in the markets, and hence I mean, it's better to be cautious.
If I have to say, if I put a gun to your head, not a literal gun, and if I say, Harsha, the next answer you have to give by not using two words, cautious and event risk. So you are not allowed to use these two words. Now tell me your market view for next 6 months. Don't use the word election and cautious, Harsha. You're not allowed to do that.
And see, earnings, the consumer driven sectors, for example, are likely to show deceleration in earnings, and that's what is going to drive overall earnings, because as expected, we have seen corporate banks showing a recovery in terms of earnings trajectory, and we should see that overall earnings growth will reach towards 20% if there is no hiccup in the consumer driven sectors. But at this point of time, most of these sectors are facing weaker demand, as well as some amount of inventory built up. So that needs to clear first, and post that we will see some kind of clarity in terms of whether the full year earnings would be met or not, and that's what will drive the markets going forward from a longer term perspective.
Harsha, we're discussing crude this morning as well, and the price of oil and the way it's spiking, and whether this could really throw a spanner in the works given the macro setup right now. Perhaps the bigger issue in the near term could actually be crude over earnings or elections or anything else.
It is possible. We have seen balance of payments turning surplus last quarter, and also we had seen a good amount of liquidity coming from foreign funds. Both of this led to a rupee kind of appreciate and remain stable. But now we have just started to see some concerns on the crude oil market, given that the waivers given to Iran in terms of sanctions would go away in a couple of days' time. We need to see whether market has completely discounted that possibility, or there is some more upside that is there in the crude market. Depending on that, I think there would be repercussions on our economy. Only saving grace now as compared to maybe middle of 2018, at least the foreign flows are quite strong now, so expected to be strong in the near term. So given that, we may not see similar impact on rupee, for example, and that should be little better than what we had seen in 2018 middle, in case crude moves up this time. But yes, our economy remains vulnerable to crude oil price movement at all points of time.
Harsha, I met Rakesh Jhunjhunwala last week, and I asked him, when do you think earnings will come through? And he said, look, Nikunj, if I tell you that earnings will come this year, it's like saying the boy who cried wolf, because earnings recovery is coming. Whether it happens this year or next year, no one knows, but earnings recovery is coming. So how does one invest in this kind of an environment where we've been waiting for earnings recovery, it's not coming? I know one day it will come, but that one day it will not be this year or next year, no one knows. So can you live in this hope?
See, Nukunj, I think that's where, I mean, you have to be focusing more on valuations. I don't think some of the names where there was steady earnings growth for last 3-4 years will continue to remain steady. At least given the way the consumer demand has panned out. We need to look at some of the other sectors where valuations may be on your side, but earnings may not be immediately visible or may not be as strong as what you would like it to be. And if there is a valuation comfort and some amount of expectation in terms of improvement in earnings, I think that's the basket that is potentially can give you a better returns than the overall market, and that's what we are trying to do. We have reduced some of our exposure into some of the consumer-led sectors such as auto, consumer durables, and even to some extent even consumer staples, and moved that part into engineering and cap goods, wherein immediately there is no great visibility in terms of earnings improvement. It's more on expectations that economic activity will pick up and the momentum will continue in terms of new orders, etc. But the valuations are on our side. For example, if you look at engineering and cap goods segment on a relative basis to the overall market capitalization, it was about 6% in 2002. That was the beginning of a big investment cycle, and today we are at about 7% to the overall market cap. So in a sense, even with increased capacities and more than 15 years, we are almost at a similar valuation like the previous cycle beginning. So it gives a lot of comfort on the valuations, and hence we have built some position there, and hopefully the earnings will come through in the due course.
Will come through in the due course, but just let's glance at the equity markets. 11,633 right now. You've got the broader end of the market holding out, but the list of gainers and losers is pretty much a copy paste of what we saw yesterday. You have DHFL, CG Power, the oil marketing companies, PC Jewelers, those are all casualties in trade today. While on the upside, GVK Power is holding out GHCL, something like Texmaco, Sun TV, as well as IBREL and then Networks, which seem to be in the green. But Harsha, I just wanted to get in a take from you. While it was only source-based ET-Now exclusive information, we understand that Reliance Jio is in talks with SoftBank's Vision Fund for a stake sale, and as of now the due diligence process is currently underway for their tower and fiber assets. This would be quite a game changer for the company. Given what Rel Jio has already done, what exactly is your outlook as to what this news might potentially mean for the company?
Unfortunately, I will not be able to comment on stock specific stories, and I have also heard it from the media that such a thing is in the offing. So we'll have to wait for the clarity and then maybe can comment on it.
Your sense on the train wreck in the NBFC space. Liquidity is back, but business is not back to normal. Do you think we are in for a permanent, a long-term top for NBFC stocks? You know, the levels which some of these stocks has achieved in September 2018, do you think it will be difficult for NBFC stocks to take off the highs in the next 6-8 months?
I don't want to generalize the entire NBFC segment, but at least some of the weaker ones would have possibly seen a big peak in 2018, and we may not see that peak getting breached at least in the medium term. But some of the stronger ones continue to remain strong, and they have no issues in terms of availability of funds or cost of funding or growing their book. I think as long as they maintain their risk management intact, I think there is money to be made in some of the leading NBFC names, but I won't say the same for the entire NBFC space. If you look at the overall NBFC space, I think clearly it is going to be an underperforming sector. But within that, there could be one or two names which will continue to gain incremental market share, especially since that space has been vacated by most of the weaker ones.
Harsha, where some would argue it's government policy or maybe free market, few free market dynamics where the competition has died down, consolidation has happened. One is aviation. Instead of 5, there are only 3 players now. One large player has got 50% market share, that's Indigo. And second is telecom. Instead of 12, there are only 3 players now. Both these sectors are going through a typical cycle of consolidation where the large leader will survive. So as a stock investor, would you see opportunity in buying the market leader in aviation, or maybe the market leader or the second or the third player in the telecom space?
We have some exposure in aviation space, and clearly we are backing some of the existing players, leading players who have the ability to take incremental market shares since that space has been vacated by one of the players. And also we are seeing a strong growth in passenger traffic in the country, notwithstanding what has happened in the last 1 month or so, which is more to do with the cancellation of flights, etc. But overall, the passenger growth has been quite strong, and we believe that this is a story which will unfold over the next several years. Despite constraints that we would have in terms of the airport infrastructure, etc., I think this sector is likely to have a reasonable kind of a growth, and also the pricing power should come back to the industry, given that there are lesser number of players. But we don't have similar view on telecom, for example, because I think the equilibrium has not been reached yet. I think the competition is still intense, and we would await for some amount of equilibrium in terms of the market share, and then maybe we can expect some pricing power coming back to the sector in that case. So between aviation and telecom, we clearly prefer aviation at this point of time.
Okay, let's talk about auto a little bit more in detail. Harsha, we've had a pretty good run on some of those names this series, but overall, of course, we all know that they're struggling right now. Would you be buying into the stress when it comes to the auto names?
No, we continue to maintain underweight stance on auto. We are unlikely to add positions at this point of time, and as you clearly said, there has been some pullback rally that we have seen in most auto stocks, but the fundamentals have not really changed. I think there is a weaker demand setup as well as higher inventory across the board, and we are not seeing that inventory getting cleared anytime soon. So I think in the near term, the results are going to be impacted by lower profitability due to either higher discounts or because of the inventory that is sitting on the books. We will have to wait and see how demand unfolds maybe after a quarter, whether this is just a blip caused by NBFC-led credit crunch, or is it something deeper than that, is what we need to see. At this point of time, since the valuations, in our opinion, have not fully priced in the kind of damage that has happened in the sector, we would remain underweight, and if valuations correct or if any of the fundamentals improve, then maybe we will look at this sector to increase our exposure.
Harsha, you know, in Nikunj's conversation with Rakesh last week, Rakesh Jhunjhunwala, he also spoke about how there is value within the pharma space. There is a report as well that has come out this morning that, you know, the easing price erosion could aid the US recovery for the sector as a whole. Do you think that despite the currency headwinds, purely in terms of earnings, it could be a fairly decent quarter?
Difficult to say because there are still some unknowns in the sector. I think it's better to still go on a stock specific basis and look at some of the names where there could be some reasonableness in terms of earnings expectations and valuation, and those would be the stocks where we would bet on. But as a sector, it still remains an underweight exposure for us.
Okay, that's the view coming in on the pharma pack as a whole. Meantime, you are seeing Z, by the way, we just flagged that stock off. There's no correlation with the move that's taken place in SL Propack, but there's also a Macquarie report. They like Z despite the near-term disruption. Subhash Chandra gone on record to say that by the September deadline, they will adhere to the strategic stake sale, that they are in talks with players from across the globe as well, who have envisaged quite a bit of interest. 417 on Z Entertainment in trade today. But the big hangover, if you will, or the factor that we're closely monitoring, Harsha, is what's happening with crude oil prices. How do you see the overall equation for some of the oil marketing companies?
See, I think oil marketing companies, more than where the crude is trending now, I think what happens in terms of their pricing scenario is more critical for their long-term valuations. I think we all know why they cracked sometime during the last quarter of 2018. There was a pricing interference by government, and that spooked the investors, because clearly if you are not sure about where the earnings are going to be, where the profitability is going to be from a medium to long-term perspective, investors may not be willing to give market related valuations. So that's what had happened in this sector for decades, and once again with the interference that came from the government, we have seen OMC stocks trading at lower multiples. Now for that to improve more than crude, I think one needs to have clarity in terms of what the policy of the new government would be in terms of the pricing, and based on that I think you can see where these stocks would go from a medium to long term perspective.
Is the drought in mid and small cap stocks getting over? I was looking at just a very simple data, 3-year return of the large cap index, the small cap index and the mid cap index. Again, you know, data, the problem with data is that you can make it suit your need. Maybe perhaps I've done that. But if I do a 3-year comparison, small and mid cap stocks are underperforming the Nifty. For next 2 or 3 years, will the tide reverse or it will remain like this only?
Nikunj, that's what we are expecting. There has been an extreme divergence between large caps and mid and small cap stocks over the last 18 months or so. I think that has started to reverse a little bit in the last couple of months, given that the undertone has become positive, and we expect that when overall economic activity picks up and if the earnings growth also comes back, then this pack should do much better than the large caps. That's the expectation at this point of time. Having said that, I think the volatility will still remain higher for mid and small cap basket, so I don't think it's advisable to chase momentum there, but if you are getting good stocks at reasonable valuations, you should stick to it.
Closing comments. Give me an example of a stress where you think that the stress in sector, stocks or the markets is temporary, and a year from now, maybe 6 months from now, markets will realize the true potential of that business or that sector. I mean, I hope you're getting the gist of my question.
Yes, to an extent I would put engineering, cap goods and cement in that basket. I think there is some amount of stress either because of lack of order flow or lack of pricing power, for example, in cement sector, which is also changing today. I think we had seen a strong several quarters of double-digit volume growth in cement, but because of the consolidation that we were seeing in the industry, especially in the northern region, we had not seen pricing power coming back to the industry. And in the last couple of weeks, we have clearly seen price increases happening, as well as that enforcement continuing. And we believe that over the next several quarters, this could be one sector which will come out of stress, because we are not likely to see new capacity additions taking place, and also volume growth remaining strong. And if you get the pricing power back, definitely the profitability should be much better. And that's what our expectation is.
Harsha, thanks so much for joining us this morning, sharing some of your views with us on the current scenario. Thanks so much.
Thank you. Have a good day.